All right, today we are diving into a really powerful idea from macro thinkers Raoul Pal and Julian Patel. They call it the everything code, and it's their attempt to answer one of the biggest questions in finance right now.
And that question is this: why have markets felt so completely, broken since the 2008 financial crisis? If you're an investor, I'm sure you felt it. It's like the old rule book. The one that worked for decades has just been thrown out the window. So, what is going on?
I mean, the clues are everywhere, right? Value investing, the classic Warren Buffett style, has been a losing strategy for over a decade. You see asset prices just climbing and climbing, even when the economic news is terrible. And real, deep recessions, they seem to have vanished. And in their place, we get this bizarrely predictable 4-year market cycle that just ticks along like clockwork. It is a genuine mystery. So how do you explain all of this weirdness? Well, the argument we're going to unpack today is that the answer isn't buried in some ridiculously complex economic model. It's actually a single, powerful force that's acting like a hidden code, a code that drives almost everything we see. And that code is currency debasement. Now, it sounds kind of technical, but the idea is simple. It's just the intentional, gradual process where governments and central banks make our money worth a little bit less over time. The best way to think about it is like a hidden tax on your savings, a slow, constant erosion of what your dollar or your euro or whatever you have can actually buy. And we're not talking about a tiny, insignificant number here. Research from Global Macro Investor pegs the global rate of currency debasement at around 8% a year. So just picture your money as a melting ice cube, losing 8% of its value, its purchasing power every single year. And that's before you even factor in the headline inflation numbers we all hear about on the news.
Raoul Pal argues this has become the single most dominant force in all of macroeconomics. As he puts it, we've basically got a factor that's so powerful that nothing else matters. He actually estimates it explains over 90% of the price moves in both tech stocks and crypto. When you have one factor that's that strong, it just changes the entire game.
Okay, so this is the most important part. If the game has changed, you have to change how you play it. If your currency is basically guaranteed to lose value every single year, just saving it means you're actively falling behind. So how do you actually win? How do you get ahead? Well, when you start measuring assets against this debasement yardstick, a really clear scorecard emerges. If you hold cash or bonds, you are guaranteed to lose purchasing power, period. Gold and the broader S&P 500, they more or less break even. They preserve your wealth, but they don't really create it. The clear winners, the only major asset classes that have consistently outrun that melting ice cube, are tech stocks, which have returned about 13% a year above the debasement rate, and crypto, which is just massively, massively outperformed. And this leads to a pretty shocking conclusion, one that just turns decades of financial advice completely on its head. In a world dominated by this one single factor, diversifying into stuff that's underperforming, like cash or bonds, it doesn't reduce your risk. It just guarantees you destroy your returns. So why is this all happening now? Well, historically, economic growth came from two things: more people, and those people becoming more productive. But across the developed world, population growth has stalled out. That engine is broken. So to fill that gap, to create the illusion of growth, governments have turned to just mountains of ever-increasing debt. And debasement, well, that becomes the only way to manage that colossal debt pile over time. But that just raises a massive question. If we can't count on more people anymore, and piling on debt is just kicking the can down the road, what's the actual long-term fix? How do you generate real, sustainable growth when your workforce is shrinking? The answer, according to this framework, isn't finding more people. The world has already tried that, and politically, it's just proven too difficult. So the only viable path forward is a technological one. The economy needs replacement humans. And what exactly are these replacement humans? Well, as Raoul Pal says, it's becoming pretty obvious that AI and robots are replacement humans. They're not just tools to make us more productive. They are the new workforce. This is the proposed solution to that huge demographic problem that's driving this whole puzzle. And this path leads us to a pretty mind-bending destination: the economic singularity. This is the predicted point in time, maybe as early as 2030, where artificial intelligence becomes so powerful that all of our core economic models, GDP, productivity, even what a job is, they just completely break. It's the moment our entire understanding of economics just collapses under the weight of nearly infinite, scalable intelligence.
Okay, so let's bring this back to one of our original mysteries. If this constant debasement is being used to prop up the value of assets, what does that mean for the normal boom and bust cycle? What happens to recessions?
The logic here is actually pretty straightforward. Big, nasty recessions are always credit events. They happen when a bunch of people default, which causes the value of collateral, things like stocks and real estate, to crash. That sets off a devastating domino effect. But in a world of constant debasement, central banks simply cannot allow that collateral to fall. By propping up asset prices, they basically short-circuit the whole crisis, making a true deep recession almost impossible.
So instead of that old boom and bust, we get a new, much more predictable sequence of events. First, financial conditions ease. Then, liquidity, the global money supply, rises. Next, all that new money floods into the most sensitive assets, which are tech and crypto, causing them to rally first. And only then, way at the end, does the real economy start to pick up. It's a whole new set of dominoes for investors to watch.
So, what's the ultimate takeaway here? What's the play? It all boils down to one simple imperative. You have to own the assets that appreciate faster than your currency is depreciating. You have to own something that can outrun that melting ice cube.
And according to this whole framework, there are two very clear winners in that race. Number one, technology stocks, because they capture the exponential gains from innovation. And number two, digital assets, because they represent an entirely new form of money that exists completely outside the system that's creating the debasement in the first place.
And all of this, it leaves us with one final and pretty profound question. In a world of constantly debased money on one side and the near-infinite intelligence of AI on the other, what is the true value of anything? It's a question that really challenges the foundation of not just our investment portfolios, but our entire economic future.